As mentioned, the second part of the IronGate Global Advisor portfolio incorporates global rotation using ETFs. And when I say rotation, I'm talking a couple different things. First off, we'll look at and always keep in mind fundamental analysis. That's important in everything that we do. We don't want to buy expensive stocks, as we just talked about in part one. Well, in addition to that, we don't want to buy real expensive countries or sectors. So we've got to keep in mind fundamental analysis as well as technical analysis. We do incorporate technical analysis, and it's very, nothing too complex, no real complex system. Just looking at a couple moving averages to tell us whether we're bullish or bearish a particular area of the globe, and that helps us gain a posture for the areas that we can potentially invest in. The third thing that we incorporate, and you got to keep in mind as I bring this up, we are a firm that believes in the probabilities of things, meaning if we do our research on stocks and we have conviction, and if it follows our method that we have been using since 1999, then we have probabilities on our side. It's not a guarantee, but it's a high probability. That also goes the same for global rotation with ETFs, meaning that we look for historical numbers and we analyze history and we understand the cycles that come with it. And all of that is to gauge and to help us understand the probabilities of making investments at certain times. And I'll address what I mean by that a little bit more. But first, let's move into the first two bullet points, which is fundamentals and technicals. And a friend of mine that I used to work with at TD Ameritrade named Pat Mullally, great guy, he came up with this term that I love, and it's called Fundo-Technicals. It's a hybrid of fundamental analysis and technical analysis. And so I stole that term from him. But the first thing we like to do is we like to look for cheap markets. And when I say cheap markets, let me give you an example. Right now, China, for example, has a PE of 12. The U.S. has a PE of around 18, 19, 20, depending upon who you ask. Certainly, China is cheaper than the U.S., right? And so we need to understand how expensive those markets are by looking at some of those fundamentals. We also gain an understanding of the government, of that region in which we're going to invest, or the ebbs and flows of the certain sectors, right, from a fundamental standpoint. So fundamental analysis is key in everything that we do, including the sector rotation. Now, we're not going to buy a market, for example, Russia right now, and Greece, dirt cheap, right? But we're not going to buy something just because it's dirt cheap, because we need the other component to be part of it, and that is technical analysis. You've heard the phrase, trade with the trend, and we do believe in that. We like markets that are in an uptrend, no doubt. It's not enough to be cheap. But just like the stock criteria that we had, we need companies that are increasing intrinsic value. The same can be said for sectors and countries that we look for. We look for countries and sectors that are in an uptrend and more or less are growing intrinsic value, so to speak. That's what we look for. Hey, the third thing that we look for, and by the way, we use, again, a moving average crossover system that I won't get into depth and detail here to tell us whether we're bullish or bearish, but it just incorporates a 10 period and a 40 period moving average, and there's plenty on our website that is written about it. In fact, I'll post a link for it as well for you. But the third thing that I want to spend most of our time with is historical sector returns, and this is something again that shouldn't be new to those that have known me for the last 5-10 years. This is nothing new, but I want to reemphasize it, because we're not here to create new things. We're here to implement what we know well, right, and become an expert. And certainly this would apply. And this is where my expertise lies within IronGate Global Advisors. Okay? So what do we have here? We have historical sector returns, and we have them for a specific time period of the year, November through April. And we have all the S&P sectors listed. Now, at the very bottom of that chart, you're going to see the S&P 500 average returns over the last, really since around 1950-ish. The average returns for that time of year is 7% per year. It's a very bullish time of year. It's a cyclical time of year. It's the time where it's the risk on time of the year, as we like to say. Well, so if we know the S&P 500 historically makes 7% per year during that time frame, and it's not a guarantee, but it's probabilities, then we know there's a few sectors that outperform the market. And I'm going to highlight these sectors. There's two in particular that we like. There's the consumer discretionary, which average return is about 11%. Okay? And there's also industrials, which we also like, that outperforms by 2.7%, so almost 3% compared to the S&P 500. Now, those are the two sectors that we like, and in large part we like them because the probability of them outperforming the market is high. Look at materials for a second, which is third from the bottom. That averages 10.1%. in that time frame. But it's about a 55% probability that it's going to outperform. When it does outperform, it really outperforms. But there's really not a high probability that materials will consistently outperform, which is why we don't necessarily like materials this time of year all the time, where we go for the 65, 70% probabilities. So we look at consumer discretionary and industrials. Those are the two that we highlight the most. And we may be wrong, we may be right, but we know at least we've got history and the probabilities on our side. And I want to illustrate this a little bit just by looking at a couple charts here, and I'll bring them up. We've got this chart right here, and I'll explain all these little boxes and everything here in a moment. But this chart is the S&P 500 ETF, SPY. And I highlighted in all of these green boxes the November through April time frame. Again, in all the green boxes. And it then has right above it the returns for those certain times of the year. Okay? And I'm just going to illustrate using the S&P 500 versus discretionary stocks, right? So we know back in, and we can even go back a little bit further if we need to. We can go to a 10-year, and I think I've got day. All right, so we can go back to 2008, when all heck was breaking loose, right? The S&P was down 11% compared to industrials, which should outperform just based upon history. Let me bring it up. It made 4.2%. So you can see in comparing industrials to the S&P, S&P's down 11. Not industrials, consumer discretionary was up 4.2. So it did outperform that during that segment. Okay? It's not going to get it every time, but certainly in this time it did. Now if we look at the next November through April time frame, the market back in 2009 was up 18%. In fact, look at this. Perfect buy low, sell high. Love it. All right. Now let's look at not industrials, but just consumer discretionary as we use the XLY ETF to do it. That same time frame, the XLY or consumer discretionary was up 34%. So when we're talking about outperformance, buy low, sell high, that outperformance has been achieved using this XLY. Now again, it's not going to do it every time. There's no sure thing ever in the markets. We're just playing the probabilities. Let's look at the next time frame with the S&P 500. The S&P 500, that next bullish time frame was up 16%. Great, buy low, sell high. How did the consumer discretionary do? It's up 17%. So it beat it by a little bit, right? About the same. It didn't really outperform up to its historical standards, but still about roughly about the same. Let's look at the next one. We had 16% on the S&P 500 back in 2011. Well, what about consumer discretionary? We were up 21%, so it outperformed. All right, let's quickly go through this, and we'll just finish with this ETF. The next bullish time frame, 13%. Great returns from the S&P and a great bull market. Well, what about the consumer discretionary? 19.2. So great, outperformed again. Now let's look at the S&P 500. 8% back in 2014. Okay, how did consumer discretionary do? Eesh. Not as good. Not as good. Flat. There's a case in point into which it didn't work perfectly. Okay, it's not going to work every time. Understand that. But so far, it's been looking pretty darn good. That's the first since 2008 that it has not worked. All right, let's look at where we are now. Where we are now on the S&P 500, and I don't have it written down. Let me quickly tell you where we are on the S&P 500. For the last time frame, we're up about 3.8%. Okay, 3.8%, where in consumer discretionary is up 13%. So that's how that cyclical nature works. And we could do the same thing with industrials. And industrials has really, especially this last November through April timeframe, hasn't been doing as good as the market. But historically speaking, it outperforms as well, right? 3.5. So it's performing right now about the same as the market. And you can go back and you can look at this yourself. Look at the numbers. See if it works yourself. But that's that first time frame that we're speaking of, November through April. Hopefully that visual made sense. And the cool thing about this is, and I want to go back and I want to look at XL. Well, we can take XLI too. That's fine. Look at the technical analysis with this thing, right? You buy the first part of November and you sell the last part of April and the first part of May. That's it. And look, buy low, sell high. No fancy, MACDs, no fancy, RSIs. It's just simply cyclical, and you're playing the probabilities. It's not too complex, but what you would need to do if you wanted to manage your own money is you need to gain the conviction that this works yourself. And so studying these returns yourself is paramount to gain that conviction that we talked about. All right? The next time frame, obviously, would be May through October. And you can see bottom line, bottom row on the slide, that the S&P 500, that time frame, is up 1%. You've heard the phrase sell in May and go away? Well, historically, it's true, although we don't want to go away. It's just more of a defensive time of the year. And if you look at two sectors in particular, healthcare, which is at 4.7, and consumer staples at 4.6. Those are the two sectors that really outperform that time frame. And I could go and I could show you. In fact, let's just take a look at healthcare. And I've got all these red boxes, right, that show you the May through October time frame, the more defensive time frame. We can do the same thing on the S&P 500. We won't dissect every period like we did consumer discretionary, but we'll give you a good idea. Going back to 2008, the S&P was up 19%. Very bullish time. The healthcare was up 17.25%. So it actually trailed the market during that time frame. Okay? The next red box for the S&P was 0.7%. You can see what happens. Look at what happens right when the market hits this defensive time of the year, pulls back, rallies unchanged. Market was 0.7. Healthcare was 1.9. So it outperformed the market. Okay, let's look at the next one. Market was down 7.5. Again, look what happens right when that time frame hits. Sell off, down 7.5. Healthcare was down 6. All right, nothing was up, but you outperformed the market with healthcare. You can't win every time, but you outperformed the market, right? You didn't lose as much as the market. Okay, let's keep going. 2.7% back in 2012. Well, in 2012 for healthcare, 11.6%. Buy low, sell high. Same type of thing. All right, I lied. We're going to look at all of them. We've got two more, right? Or two more to look at. We've got 14% in the XLV healthcare ETF. That's back in 2013. And then we've got this one in 2014. So 14 and 16 were the two periods there. Let's see what the market did. You did 12, so you outperformed right here, and you outperformed right here. This is the market. So you're outperforming the market during those certain time frames. And healthcare has been on a roll, and I'm not going to get political as to why or anything like that, but I'm just playing the histories, the probabilities. That's it. And you could do the same thing for consumer staples as well to give you a good idea as to how this works. But when we're talking sector rotation, that's in large part what we do. And so, in fact, what could be done, and this next slide is a potential strategy. It's not a recommendation. It's a thought, right? A thought. And then you can tweak it however you best feel, or you can contact us and we'll manage the money for you, of course, right? So November through April, what could you do? Well, you could take your allocation to the U.S. market. You can say it's going to be 50% in the SPY or an S&P 500 ETF. Could be the VEA, the Vanguard Fund. Could any S&P 500 ETF. Perhaps look for those commission-free ETFs, from whatever brokerage you use. And so that would be the first thing. And then you could go industrials, I'm going to go 25%. Discretionary, I'm going to go 25%. So you're overweight those sectors. Now you still have exposure to all the sectors in the market just because you're buying the S&P 500. But certainly you overweight those two sectors specifically. And in May through October, you do something similar. You go 25% in staples and 25% into healthcare. Now, we haven't as a firm been implementing this particular strategy for that long, and so I have to use hypothetical returns. And this is what would have happened if you would have allocated your portfolio, as that last slide showed you, from November 1998 through April of 2014. The S&P 500, if you invest $500,000, that's your beginning balance, far left side, beginning balance $500,000, you'd have $686,000, which is awesome. Great, you made $186,000. Maybe not so awesome in 15 years, 16 years. Yeah, okay, maybe not so awesome. But with this sector portfolio, which is the orange line, you would be up to 1.17 million, right? 1.1 million. And that's not to say this is going to continue to work. There's no guarantees of anything moving forward, but that gives you a good idea of how the probabilities work with this sector rotation. In fact, here's the numbers. I showed you the numbers on our AltCap value portfolio. Here's the numbers on the sector portfolio. The total return on the sector portfolio was 134%, annual return 8.9, S&P 500 same time frame. Now keep in mind that's two bear markets. That's the bear market of 2000 through 2002. That's the bear market of 2008. Your annual return on the S&P 2.4%. In fact, you can look at the line here. The sector rotation portfolio dips below the 500,000 line once at the late of 2000. And let me grab my little pointer right here. Dips below your initial investment of 500,000 once. And that's simply because you get defensive with staples and healthcare and you're growing risk on, risk off. It's not perfect, right? You were up quite a bit in 2006 and 7 and 2008 without any risk management using options or technical analysis. You dipped almost down to your original investment, but certainly it's been firing since, right? So interesting, the hypothetical returns on that particular portfolio. That's the second part. And I didn't touch the global portion, meaning investing in the emerging markets, investing in Europe and in Asia, Australia. I didn't touch that. But just with the U.S. and the U.S. sectors, that's the potential that you have using and understanding that historical analysis. So now we'll move to part 3 of building a portfolio, which will look at options. And I'm going to share with you some rules, in fact, with options. And we'll also discuss cash. So we'll do those 3 things in this part 3.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.